This started off really as, hey, let's look at the quarter, because this is really like a battleground quarter, as I would call it. It evolved into, I think, more than that. So here's a 60-page deck which walks through what you got to look at in the upcoming quarter, and also why we think ultimately we're going to see a dividend cut, and there's going to be a clear roadmap to extinction here. And you got Bigfoot on the cover. I think it's Bigfoot. We actually used this about a year and a half ago, Al.
Yep.
It was when the street was sitting there at $5 in earnings, and the point then was, hey, it's like Bigfoot. You could talk about it and you're never going to see it. Still the case. Street's still over $5 in earnings. We're closer to $4, and I think before we see even $4.25, there's a better chance that we see sub $3. So big point there. So let's just go over the thesis real quick. This is on page 5. Excuse my paper rustling here on the mic. So as far as this quarter goes, this probably hasn't been a quarter in a couple of years where this company should beat. If it can't beat in this quarter, I don't know when it can. Earnings expectations in the last quarter, we had earnings growing 13.5. In this quarter, expectations are for down 5. Since then, inventories have cleared out. You got this weather trade, which I don't know if I buy it, but and a couple of other factors which lend to, and also credit is a big deal. We're not going to see this company spanked by credit, I think, for another 2 quarters. And we have a lot of slides on that because it's, I think, very critical here. What else? Road to a dividend cut. I think what we're going to see, and this is in our cash flow numbers, it's in our model. As we see the cycle turn here, you'll see a dividend cut. And then we see the cycle, of course, come back up again, as always happens. And then we get to a point where we're going to see store closures. We're going to see earnings come down. We're going to see gross margins come down. SG&A, I don't know if it can cut anymore. But essentially, we build up to a pretty good case for earnings to do very, very bad things. As a point of reference, we have cash flow, because I always hear about this. It's like this in Foot Locker. It's a couple of names where everyone's like, no, you can't short him, it's got great cash flow. Our cash from operations in our model over 3 years is going from $1.6 billion this year to $650 million in 3 years. Again, that's a dividend cut. That's no more investing in their business, no more stock repo.